All right, let's talk about a giant in the spirits world, Diageo. If you've ever had a Johnnie Walker, a Guinness, or a Don Julio, then you know their brands. They literally own the top shelf. But lately, their stock performance has been anything but top shelf. So let's figure out what's going on.
The stock has really been stumbling, which brings us to the big question for this whole explainer. Is this just a temporary hangover for a great company, something that'll pass? Or is the party, truly over? We're going to dig into the numbers and find out. And let's be clear, what a business this is. We are talking about a portfolio of absolute legends. Johnnie Walker, Guinness, Tanqueray, Don Julio. These are timeless brands with some serious pricing power, which of course just makes it more of a mystery. Why would a company with assets like these be struggling so much in the market?
Okay, before we get into the thick of it, just a real quick technical note. You're going to see the stock ticker is DEO. That's what's called an ADR, or an American Depository Receipt. All that means is Diageo is based in the UK, and this is just a certificate that lets us trade it super easily on a US stock exchange. It's that simple. Okay, with that out of the way, let's get on with the investigation.
So let's start with the official story. I like to call this the poet's bad news. This is the story you'll read in all the headlines, the one coming straight from the company's earnings report. And, on the surface, it looks really, really grim. Yeah, check out that headline number, a 28% collapse in reported profits. When you see a number like that, your first instinct is to panic, right? To think the entire business is just falling apart, that people have completely stopped buying their drinks. It looks like a 5-alarm fire. But hold on, we always have to check another source. So now, let's go listen to the teller's true story. See, the teller doesn't write poems or press releases. The teller just counts the cold, hard cash in the bank account. And the cash, well, it's telling us something completely different. So instead of a total collapse, the teller says the company actually generated a positive $2.75 billion in free cash flow. So, wait a minute. How is that possible? How can profits be crashing at the exact same time the company's bank account is growing? One of these stories is not telling the whole truth. And this right here is where we solve our first mystery. That scary 28% profit crash was caused by something called impairment charges. This is basically just an accounting rule. Think of it like an accountant having to delete some value on a spreadsheet. No real money actually left the company. It's an accounting fiction. The teller, who only deals in reality, shows us the business is still an absolute cash-generating machine. The business is not dying. Okay, so if the business isn't dying, why on earth is the stock performing so badly? We've just debunked that whole profit collapse theory, so now we can uncover the real culprit, and it's sitting right there on the balance sheet. Here it is. This is the number that really matters. 3.4 times. That's Diageo's leverage ratio. It's their total debt compared to their earnings. And in our book, any number over 3.0x is a serious red flag. What happened is they borrowed a lot of money, especially to buy up tequila brands, right before interest rates shot up. And now they're feeling that decision. I think this slide says it best. The debt is like a heavy backpack. It's not going to kill the company, but man, it slows everything down. Every step is just harder. Cash that could be going to dividends or to buying back stock is instead getting sent to the bank to pay down interest. This is the real reason the stock is being held down. Okay, so now we know the business is fundamentally healthy, but it's being weighed down by all this debt. So for the final part of our investigation, let's figure out what this company is actually worth. We've got to weigh the price against the real value. So here's the math. Today's price is right around $91.45 a share. After we run our analysis, factoring in those incredible brands, but also that heavy backpack of debt, we calculate a fair value of somewhere between $85 and $90. So what's the verdict? The stock is trading right at fair value. And this quote just sums it all up perfectly, doesn't it? At today's price, you are not getting a bargain. You are paying a full and fair price for a fixer-upper. It's a wonderful property for sure, but it needs some significant repairs before it can really shine. So the bet you're making at around $91 is pretty straightforward. The bull case is that management uses that strong cash flow to pay down the debt and do it aggressively. If they do that, you could easily see the stock getting back to $120. But the bear case is that a weak economy pushes people to trade down to cheaper drinks, which would squeeze their cash flow and make that debt backpack feel a whole lot heavier. So what should you take away from all this? Honestly, it all comes down to one simple question. This is the key variable you need to watch going forward. Can management get that debt backpack, that leverage ratio, back below that 3.0x threshold? If they can, hey, the party might just be getting started. But if they can't, this hangover could last for a very long time.